And because Cathie Wood has only about 30 or 40 holdings, and they're all sort of, in my opinion, disruptive technologies, people try to tell me, well, they're in different industries. They're in the tech industry. We've seen what happens when bond yields start to rise, how tech is affected. We've seen other previous crashes where tech bubbles form, tech bubbles burst, and then tech goes to underperform, I don't know, 15, 20 years until it becomes relevant again, like it is now. So I just caution people that people think that history doesn't repeat itself, but we've seen this many times over and over again.
Warren Buffett knows what he's talking about.
Don't you mean Warren Buffett?
I don't know when you're going to publish this, but I'm going to be doing a live stream on my channel this Sunday. But I finally quit my day job. I'm going full-time on YouTube. Believe it or not, with 5,000 subscribers, there's enough money to be made where I can go full-time. So I'm going to be doing
awesome.
that and really pushing sound investing advice, not so much the stuff that I was focused on before. Now I'm kind of an index fund channel, and that's where I want to be. That's where, I don't know if you remember last time we talked, but I said like 90% of my investments were in index funds. That's where I want to be. And that's kind of the message that I want to push out, and just excited now that I can go full time. I got the private membership stuff coming, and a couple other things down the road that I'll announce a little bit later, but just excited.
Yeah, let's talk a little bit about making that switch to full time, because I'm sure not only is that a little bit emotional, right? Because you're letting go of the security of, I would assume, kind of a stable job. But how did you line that up to kind of realize, you know, I'm bringing in the money that I need right now where I can go at this full time? What was that process like?
Yeah. So for me, if you remember my story, I paid off $87,000 worth of debt. Once I became debt free in 2019, I could live off of $2,000 a month, all my other bills. So because I was able to live off $2,000 a month, and I'm married and my wife has an income, my job was just me working to contribute to my 401k. So I was maxing out my 401k at work. And then anything I had left over was just extra spending money, beer money or whiskey money or cigar money, whatever you want to call it. But it was just money that I wouldn't really consider, you know, life-changing money.
Right.
So I said, I can part with this to follow my passion, which has been really to educate people. I love educating people. And I said, I can part with this beer money to make a little bit less money on YouTube, but at least I get to do what I love to do, and get to interact with my followers and get to really expand the brand. I've always been about the brand since day one. I didn't want to make the channel about me because I had future plans to make this a brand, and eventually maybe somebody can replace me as the talking head on the channel, but you know, it would still be, you would recognize the brand. So that's kind of where I'm headed with that. But really just excited about the opportunities. I think I never in a million years would have thought that that's how long it would take to get monetized. I got monetized April of 2020. My first paycheck was like, I don't know, $24 or something like that. And to go from there to now where I'm making like 1,200, 1,300 a month on YouTube is like, and there's just ad revenue. It's nuts how fast it can grow and how quickly it can grow. So just excited about that, and the transition and all the free time and all the effort I can put now into having a full-time channel versus before it was all part-time, and I was putting, you know, hours where I could find them. Now I'm just open pretty much all day to do what I love.
So is it official? You officially cut ties with your old job?
Yes, last Friday was my last day of my old job, and that's it. No more, man.
How'd that feel?
Surreal at first. I said, is this the right decision? I talked to my wife like probably 30 times. I'm like, here I am voluntarily leaving a job. Man, I can't remember if I've ever done that and not have like a backup to a backup. And it just felt surreal, man. It felt like a dream come true. And honestly, I feel it right here. Like it's the right decision. And maybe now, you know, money's not that great, but again, it's enough to pay the bills. That's all I ever needed. And anything past that I would always consider a bonus. So I'm just truly blessed and honored that I can do that. And really, hopefully, if you guys, I know there's a lot of content creators that you bring on and that are still, you know, chugging along with YouTube. You yourself, you've grown your channel quite a lot. I think when I first met you, you had like maybe 50 subscribers. So
Yeah,
keep at it, man. It took me forever, but just keep at it, and focus on your audience, whoever you're making the videos for, because they are the ones that are going to be driving the watch time and really driving the YouTube paychecks. Not that it's about the money, but it helps when you have a loyal audience that watches your videos all the way through and really just pushes, you know, every time you upload, they push or click on your video and watch it. It means a lot.
Yeah, I think you know, it comes back to that concept of 1,000 true followers are better than 1,000,000 laissez-faire followers, right? I'm sure. I think you see that on your channel because you bring in some really good numbers for, you know, your subscriber to view count. So clearly people are liking what they're seeing. Now it's just about continuing that trend.
Exactly. Yeah. I mean, I never was about the numbers. I mean, I wanted to get to 1,000 subscribers so badly because my watch hours, I got there, but my subscribers didn't get there. And everybody else that I talked to, as far as the content creators, it's like, man, you know, we got our subscribers, but we don't have our watch hours. So everybody was kind of opposite. And I didn't understand at first why, but now I see that it's more important to have the watch hour. The subscribers, just once you get past 1,000, doesn't really mean anything. I think my views, maybe 15% come from subscribers. The rest is really the YouTube algorithm pushing out my videos on the YouTube homepage and stuff like that because of my audience engaging and watching the video so long. So that's a little helpful tip. I didn't know back then. I didn't even know what I did to get my watch time to be like 60, 70%, but now it's like 54, 56%, but still pretty good considering I'm putting out sometimes, you know, 15, 20-minute videos. So it's pretty good that the average view duration's at like 10 or 11 minutes of video. It really helps with the money because you can put ads in the first 10 minutes and you can, I don't know, play 3 ads. So you just 3x what anybody else would make off a video that's, you know, where they have a watch time of 30% or something like that. So it's helped the revenue side a lot.
Yeah, that makes total sense. For those who didn't catch last episode or aren't familiar with you, let's just kind of take it back to where this all started, right? And then maybe after that, we'll talk about what we've seen over the past year since our last episode.
Yeah, for sure. So for me, it started back, I became a YouTuber in October of 2019, but even before that, really in July of 2017 is when I got laid off from a really good job. And I freaked out financially because I had a lot of debt and no secure source of income coming in. And I realized I had to make a change. So I found Dave Ramsey and got on the baby steps and paid off $87,000 worth of debt in 12 months. Was very proud of that at the time and wanted to have a platform where I can come out and share really talking about debt-free and talking about personal finance and educating people on personal finance. So I started my channel and a couple of videos I made were about that, but they didn't take off like the investing ones did. And then I started doing investing videos, stock videos, dividend stocks and all that stuff. And from there, I think that's when I left you. I had a M1 finance portfolio the last time me and you talked, and I was talking about dividend growth investing. And from there, in June of 2020, I said, you know what? I'm just going to show people index funds because that's what I do. And I was so afraid to introduce index funds because they're so simple. Like everybody should know that you buy an S&P 500 index fund. Like what can I possibly say about that over and over again that would kind of encourage people to watch? But I did it anyways. And one of my videos, it was like a Fidelity top 3 index fund videos, blew up. It got like 20,000 views. And I'm like, wait a minute, people do want to watch this stuff. And I really transitioned full time now into index fund investing. But I mean, we go into the nuts and bolts of index fund investing. We break down funds. We look at PE ratios, price to book ratios. We look at compositions, holdings, weightings, all that stuff, and really just get the inside those index funds and try to help people understand, you know, there is more than just the S&P 500 when it comes to index funds. It's like a whole another world once you uncover value tilts or size tilts and all that stuff. So that's where I'm at right now with the channel and looking to expand that message.
I think because you're self-aware that especially in the YouTube investing world, index funds are certainly not the shiny object and I think people are going to be attracted to necessarily. That's why you're so good at doing what you do, because I'd say if you look at your recent videos, right, probably the vast majority of them are about index funds. And you do a really good job of making it interesting by explaining why it's so important that people primarily focus on index funds, especially for beginners. So just give us a quick synopsis. Of course, your channel is always there, but why are you so passionate about index funds and why is that what you encourage people to go after so much?
I think the biggest reason I'm passionate about it is because a form of investment that can work for anybody. So whether you're a beginner, intermediate, or even you've been investing for 20, 30 years, this concept or idea that I can buy a couple of funds that own the entire stock market or the entire world, if you get a total US and a total international fund put together, this idea of something like that. And if you're young enough, like some of these beginner investors that I've started to get to my channel now who are in their 20s and they're sending me emails like, oh my God, if you're 20 and you just put $100 into an index fund, like an S&P or total US stock market, for the next 35 years, that's all you have to do is put $100 in. You're going to be a millionaire at 65 when you retire. Versus if you're 20 and you put it all on a high spec play, as I dub them now, lottery stocks, because they're either going to make you really rich or they're probably going to tank your portfolio. So those are two different philosophies, like get rich slowly. And we've talked about this before, get rich slowly or get rich quickly. Here I have something with index funds that anybody can do. And it's so simple. You got to own a couple of funds and you can become a millionaire over time. So I really try to just share with people, time is important, patience is important, and knowing what you're invested in and knowing why you're invested in it, so that if a rocky road or the seas get rough, you kind of understand and you can stay the course versus jumping off the ship when maybe it was only a 10% dive, but you jumped off and now it's skyrocketed and you don't know how to get back in. So really it's just the simplicity of it, how anybody can do it, and you don't have to have a lot of knowledge to do it, because most people don't care about investing like me and you care about investing. Most people just want something where they can put their money in and just let it grow and not worry about it. At least that's what I like to think, and hopefully I can reach those people.
And I know you prefer index funds over ETFs, especially because when those rough times come, if people don't have the knowledge and the wherewithal to hang on, it makes it a little bit harder for them to just jump ship. Is that correct?
Yeah. So the biggest reason I like mutual funds, which are kind of like a boomer way to invest. I mean, it's how your dad or grandpa invested, is they don't update every single minute like ETFs. They update at the end of the close of the market at 4:30 Eastern time. So I'm not really inclined to check my portfolio. Sometimes I go a whole week without checking my portfolio, and most times I check it to update it for the YouTube channel. But it helps me kind of stay out of the goings or whatever is happening in the market that day. It helps me avoid that noise versus when I had ETFs, and I still do have some now that I started like a beginner investor series. Man, sometimes I log in like 4 or 5 times just to see what that ETF is doing. And at least now I'm good. I would like to think I'm a good enough investor where it doesn't bother me and I'm not going to sell. But in the beginning stages, if I logged in and I saw my ETF was down 2%, I would freak out and probably want to make some changes, because I'm like, why is this down 2%? Versus if you're investing in a mutual fund, it could open down 2% and still end up closing up. But if you would have sold out because you were in the ETF, you missed that whole upside. So it goes back to market timing. I think the biggest reason ETFs were created back in 1994 was for institutional investors to use them as a trading tool to hedge against market risk. So still about 70% of institutions own index funds, and only about 30% are owned by actual retail investors when it comes to ETFs. So it's still primarily used as a trading tool by institutions. And I think if more people were aware of that, they would probably like mutual funds a lot better too. But ETFs do have their advantages with tax efficiencies in taxable accounts. So I can't downplay that importance. But in retirement accounts, I think mutual funds all the way.
Yeah, I mean, I know you mentioned this, but an ETF can, in theory, act as an index fund. If an ETF and an index fund are both tracking the NASDAQ, they're going to do the same thing. It's just that the index fund kind of puts those bumpers up when you're bowling, so you can't throw it into the gutter halfway through the day.
I love that analogy. That's a perfect analogy. Yeah. So, and one other difference is the bid-ask price or the spread on that on an ETF might not be what the net asset value price is of the ETF. So at the close of market, when I buy a mutual fund, if I buy the mutual fund that day and you buy the mutual fund that day, we pay the same price for it, whatever the net asset value price is. With the ETF, if you're using a broker that has a bigger bid-ask spread, you might be paying 2, 3, 4, 5, sometimes I've seen 7, 8 cents more per share than some other broker. And a lot of these startup brokers are notorious for this, which I later found out. They really make their money in that bid ask price or in that spread. So sometimes, depending on the timing and depending on those fees, they're kind of hidden fees, you might be better off with a mutual fund. But again, it's such a minor difference, it probably doesn't even matter. But yeah, I like that. You got your safety gutter, or whatever those things are called, so your ball doesn't go in the gutter, and that's the best way to describe it.
Yeah, exactly. Well, while we're on the topic of ETFs, and specifically while we're on the topic of knowing yourself as an investor, let's get into some talk about ARK Invest, because I own a few ARK funds. I know you don't own ARK funds. However, I want to talk about this, and I think we're actually going to have a lot more agreement than disagreement on this. So just kind of give your 2 cents on ARK, and I know you made a video on this, but I'll just kind of let you go first.
Yeah, and first of all, I don't want to come off that I'm against ARK. I know sometimes I come off that way. Absolutely not. If you have your convictions, my opinion shouldn't matter to you. And I know you're that kind of investor where it won't. So I'm not talking to you, but there's a lot of people when I was looking and doing research into ARK funds, that the inflows started coming in after the crash in March 2020. And that's really where the outperformance started. And a lot of people just kind of jumped on the hype wagon. But then when I zoomed out and I looked at what other funds have done this, I found many funds that have done this over many different decades. And it goes back to the idea that we put so much trust into a fund manager to predict the future, and they can't do it consistently. They can do it 5, 7. Peter Lynch did it for 13 years. But they can't do it past that. Eventually, that fund manager will retire. They're going to go start their own fund. They're going to do something else. We've already seen a little bit of a battle with Cathie Wood and whoever the management company was. I think they square that away now. But she's old. She's going to retire. She can't be Cathie Wood forever. Eventually, she's going to retire, and eventually, this outperformance has to end. So as a long-term buy and hold investment, I just can't see, not just ARK, but I can't see any active management. How can you buy and hold it when you don't know what the future is of that fund? And then the second point is with disruptive technologies. I'm a huge believer in disruptive technologies, as we've talked before. But the fact is, I recently saw an interview where she said that index funds don't or can't have these disruptive technology companies that she has in her funds. And I think that's so far out there, and it's stretching it, because yes, she can pick disruptive funds, but the index eventually will have the ones that grow or they're the biggest. So for example, if you just look at the S&P 500 and you look at the top 10, you see a lot of Google, you see Tesla, you see Amazon, you see all these companies that 20 years ago didn't really exist. So the index funds always picks the winners, and it makes them a heavy weight in the portfolio, where there was plenty of companies like pets.com that didn't make it, unfortunately, or I don't know how many social media competitors there was to Facebook, but they didn't make it. So the index fund doesn't pick, like, try to guess what the winners will be. It just ends up, because it's a market cap weighted index, it just ends up holding more and more shares of the winners, and the losers either don't make it in the index. If it's an S&P or if it's a total market, they have such a small weighting that when they do eventually fail, they have no weight to what the performance of the index is. And because Cathie Wood has only about 30 or 40 holdings, and they're all sort of, in my opinion, disruptive technologies, people try to tell me, well, they're in different industries. They're in the tech industry. We've seen what happens when bond yields start to rise, how tech is affected. We've seen other previous crashes where tech bubbles form, tech bubbles burst, and then tech goes to underperform, I don't know, 15, 20 years until it becomes relevant again, like it is now. So I just caution people that people think that history doesn't repeat itself, but we've seen this many times over and over again with fund managers, with disruptive funds, whether it was in technology or whether it was in different fields, and they always end up the same. They always end up flat on their face, and they usually close or go out of business within 10 or 15 years since they're from when their hot streak began.
Yeah, it's funny you bring up Cathie Wood's age, because you wouldn't think that she's as old as she is, and she's not incredibly old, but I think she's in her late 60s or something like that.
Yeah, I
so
think it's 52 or something like that, if I remember correctly.
Okay, so at some point she's going to want to be done with this. It's like she's not going to want to do this forever.
She's been in the investment industry since 1972.
Yeah.
And my whole thing is, where was she since 1972? Nobody's ever talked about her. She's been in the investment industry, and I hate to say it, but she got lucky with this disruptive stuff. Yeah, she had a great, crazy bull thesis on Tesla that I loved, and I don't love anymore, but I loved, and part of it was skill, yes, but most of it was luck. And if she is as good as people say she is, where was she since 1972? It was really, she was running a lot of technology funds even back in the internet bubble, but nothing came of it until now.
Yeah, there's not a whole lot. I've done research on it as well. I mean, I've just been kind of able to catch where she worked here and there, but she didn't really come onto the scene until this past few years. So it'd be interesting to do a little bit more of a deeper dive on that. But I think the biggest thing to take away here, and I know it's something you've talked about before, I think it was with the Magellan Fund where they outperformed the market every year for 10 plus years or something, 13 years. But something like over 80% of people invested in their fund lost money. Yeah. And the way I think about this with ARK is, let's say they did 100 times return in 2020. I don't know the exact for each individual ETF, but
127 for ARKK.
ARKK, cool. Let's call it 100 just to make it easy. So 100% return in 2020. They could have a 0% return for the next 4 years, and they'd still be averaging a 20% return over a 5-year span. So unless you caught it at the bottom, right, and you're expecting to outperform the market like a 20% return, you're probably not going to be there exactly on time. So if you have the wherewithal, like we talked about previously, it's something you believe in, and you can buy when you see it drop 5, 10, 15, 30% so far this year, knowing that you're going to hold this for 5 to 10 years, then it's a completely different story. And my kind of story with ARK is, it was about this time last year where I started to hear about them. I'm sure the first reason I bought, I'm in 2 of their ETFs. I'm sure the first reason I bought was just because you hear the hype, right? Yeah. All you're hearing is hype. And luckily, I probably did catch what was close to the bottom based off of where they are today. Now, I didn't invest a ton at that time, and I've been kind of dollar cost averaging as we go. And as I kind of did more and more research, it did build my conviction on, where I could see these things. But it's funny that I'm happy we're having this conversation now, because the exact things that you're saying in terms of the issues with actively managed ETFs versus, whether it's a broad-based or even just a NASDAQ tracking ETF, is the things that I've started to think about more and more now. And of course, as you can imagine, with those type of returns, my ARK holdings have gotten a little bit out of whack in terms of weighting, even with the 30% pullback. So my focus over the past few months and going forward is to try and balance this out by investing into whether it's QQQ or something a little bit similar to that to kind of get rebalanced. So I'm probably a little bit more of a believer in what I think ARK can do, but I 100% agree with almost everything that you're saying. So I can kind of see both sides of it.
Absolutely. Yeah. I mean, again, you are the kind of investor that I think is very rare out there when it comes to ARK funds. You did get it at a perfect time. And even if you've been dollar cost averaging up, your average cost is probably still a lot lower than where it's at now. Cause I think it was at like 30 or 40 bucks back in March or whatever it was. Again, yeah, that statistic is with the Magellan Fund is real, that 80% of the investors actually returned a negative return by owning that fund. And the reason is it wasn't even an ETF, it was a mutual fund, but they were still trying to time it. And it goes back to timing. We're terrible at timing stuff. Sometimes a 0.5% correction might make us feel a certain way, and we sell out when on the upside, there's like 20% to be gained. So absolutely, there is still a thesis that you can put out for ARK Invest, and to say that long-term, it could be a buy and hold if you bought it at a good enough price. What I'm seeing on my channel and the people that I'm talking to, they're paying 140, 150 a share, and they saw my video, and then they're saying, well, it's going to go to 200. And now it's at I don't know where it's at.
112, 113 today, something like that. Yeah,
so now it's at that, and I'm kind of pushing their buttons, and I'm saying, oh, look at it now, to see if they're really, if their conviction is in ARK, or if they're just hype people that jump from one thing to the next thing. And a lot of people I'm finding are either, selling out of it at this price after paying 150, which blows my mind. If you liked it 2 months ago, why don't you like it now? Like, nothing has changed. my opinion, shouldn't.
Everything's gone down. So
exactly. And to mention that, technology and QQQ and the NASDAQ, I mean, they've been hit just as hard. I mean, Apple, Tesla, all these big tech stocks have been hit hard. And I think a lot of the times, at least what my research has shown is that, and I'm starting to do more of this transition on the channel, is growth stocks, unfortunately, are not where we want to be long term. It's actually value stocks. And it seems counterintuitive. Like, why would you want value stocks that are out of favor, like oil, or value stocks like real estate that are out of favor right now? But that's really where the returns come from. And especially some of the research that I've done in the 3-factor model with Fama and French. I know I didn't really mention this before, but that's really where I'm going now is small cap value, mid cap value, large cap value. So zooming out and not looking at broad-based funds, but looking at equity styles. And I think small cap value over the last 50 years has returned something like 13.5%, while large cap growth, which is kind of where I would probably place ARK Invest, maybe mid cap, large cap growth has done something like 10.8. So large cap growth has barely outperformed the market, which has done 10%, while small cap value has done 13.5. So there is more, I feel like, to be gained by investing in value than there is in growth, but that's just a whole nother topic. But it's one of the reasons why I sold out of technology when I did in September of 2020. I don't know if you've been following the channel, but in September of 2020, I sold out of all my large cap growth, all of my tech stuff, and I switched it over to small cap value. And since then, small cap value has done about 42% or something like that, while large cap growth's been negative. So luckily I found that. I timed that perfectly. That was an accident. I'm no market predictor. I had no idea that would happen at that time. But really for long term, I'm going to be more on a value tilt, and I'm going to be in index funds and broad-based for the core, and maybe 20-30% in a value tilt. And I'm going to be staying away from growth. So nothing to say that, growth might not perform for the next 5 years. We've seen it do it in the last 5. It could do it in the next 5, but eventually, historically, it hasn't, just because evaluations get so high. And eventually these companies, their stock prices outpace what the actual technology of the company is. We've seen in the internet bubble where you had all types of internet companies that had great ideas, but they just, the technology wasn't there. And I think ARK Invest has some great companies that have great, 20 years from now, we're going to be talking about them, but not all of them. And maybe none of them that are in ARK Invest. Maybe another competitor will come in and copy that and do better than them. But EVs are the future. Automation is the future. Robotics is the future. All that stuff is the future. We already know that. It's just that the current valuations are way too high for what technology we have today. And unfortunately, a lot of future growth's been priced in, and we're going to see that growth come tumbling down sooner rather than later, I think.
Yeah. I think a few things on that. One, I always talk about how volatility works in both directions, unless this is like a situation where a company is just tanking. But if it's or an ETF, something that's relatively well performing, if it's volatile in the up direction, it's going to be volatile in the down direction. And so that comes back to, is this something you can stomach, right? I think the NASDAQ was down, I think at its lowest, like 12%, 11% this year, something like that. And ARKK, for example, was down 30%. And then when we had the short recovery, it looks like ARK like skyrockets, and the NASDAQ's up 1% or 1.5%. So it really comes down to being able to stomach that volatility. Unfortunately, going downhill, it's a lot more difficult than when you're going uphill and you're seeing these massive red days, especially in the ARK funds. And then I think the big thing that Cathie Wood and ARK, what they are doing is, it's a massive assumption that what we're going to undertake over the next 5 to 10 years, and you touched on it already in terms of automation, robotics, all of these things, they're basically expecting this extreme revolution to happen. And if it does happen, as I think they are predicting, then I think their funds are going to perform exceptionally well. But to play kind of devil's advocate for myself on this, a lot of these technologies that we've been hearing about, they should be here by now, and nothing's happened, So I think about Tesla, for example. I'm still a huge fan of Tesla. It's a very large position of mine by nature of growth, luckily. But, and I love Elon Musk, but he's been calling full self-driving for 2 years now or whatever it is. And we will get there. I think we'll get there in the next probably less than 5 years, I'd say. But, I don't know if you've seen any of the beta testing videos of the Teslas doing the attempted full self-driving, but it's scary, man. I wouldn't trust that thing. So if things progress the way that they're expecting, I see a lot of success for them. But, if things lag behind due to whatever, COVID drags on, whatever the case is, then it could be kind of a lot more difficult for them to get the gains that people are expecting.
Yeah, I agree with that 100%. I think, yeah, I mean, it goes back to the point, the current evaluations of technology companies are way higher than the technology. I mean, Tesla's keep sending updates on like computer games, but where's the self-driving, man? Like you said, it's going to be here 2020, it's going to be here 2021. When is it coming? So yeah, it's so hard to predict when that kind of revolution starts, because even I keep going back to the internet bubble, but the internet, if you just want to think, in 1995 was the greatest innovation that we've ever known, but it took like 15 years for everybody to jump on board, and companies like Facebook and Google to really become profitable. So we're on the early stages of this stuff when it comes to the EV and the automation and the robotics. I know it's the future. I mean, unless you just like oil or combustion vehicles, or you don't believe that a robot's going to take your job, then, that's your prerogative. But I think it's the future. I know it's the future. It's just way too early to predict which companies will be good at it. That's my whole thing on it, is the companies that we see as winners today, like a Tesla, who's a clear-cut winner. What's to say that another company can't come along, copy everything Tesla has? While Tesla has had the first mover advantage for a long time, I think these other companies are closing the gap. And I'm seeing companies that are going to be probably coming to market here or shortly that might be able to compete with them from day one. And once you bring that competition, eventually it's winner take all. I feel the good ones stay and the bad ones fall off. And I just don't like the idea of a human being picking which one will be good in the future and which one won't be. I think it's a very flawed investment strategy long term, because no human, even Warren Buffett, who's a great value investor, by the way, he's been able to do it. But there's a reason we mention his name, or we mention Charlie Munger or Peter Lynch. It's a handful of people. You can count on a couple of hands that can do it. Everybody else tries to do it and sells you this narrative of this is the future, but many times they fall by the wayside. So, but it'll be interesting to see. I think I definitely see and I understand why people hold it for the long term. And I agree with those people. I'm just really against the people that are bought it at 150 and are selling it at 120 to then go buy it at 150 again when it's at 150. Those are the people that I'm trying to reach and tell them, don't invest like that. If you have your beliefs, stick with it. Turn off. I keep doing these community posts. Turn off your phones. Don't look at your portfolios. It really, it's just going to discourage you from thinking that you're a smart investor, because most people actually do think this stuff out before they invest, which I'm impressed by and agree with. And I just want everybody to stay the course. I don't care what they're in, even if they're not in the stuff that I'm recommending, stay the course. And eventually it has to pay off. Every investment I like to look at it as like a horse, whether you're in ARK or you're in a VO or a QQQ, they're all just different horses. All the horses make it to the finish line. Just some get there faster than others, but they all get to the finish line. So that's the big picture that I want people to see. Don't look at it at what ARK is today. Maybe in the future, it's going to be the biggest, best thing we've ever known. Maybe it's not, but eventually it's going to return something. And that's the most important thing.
Yeah. What would you need to see out of ARK for your sentiment to change? I mean, anything?
No, because I don't believe in active management, and this is a flaw of mine. And this is the guy. Let me get his stuff here. This is the guy that I've read all of his books now, and I reread a lot of his stuff. But Jack Bogle, I'm biased when it comes to active management because of him, because I know what 0.5%, so 50 basis points, what it can mean for somebody over a lifetime of 35, 40 years of investing. It could mean sometimes $200,000, $300,000, and they can't make that up in performance, right? So the average returns of all these great active fund managers when you put them all together, they make the average, they make the index, they make what the market is. So one will be better and the other one will be weaker, but eventually there's this principle that's called reversion to the mean. It's also a biblical verse: the first shall be last and the last shall be first. They're always trading back and forth between one another, creating turnover, really just creating a lot of havoc in their funds to justify the expense ratios. But then when you kind of pull them apart like I do, and I look at the funds and I say, wait a minute, you're not doing anything here that is that an index fund can't do and does better than you for cheaper. So I'm so sensitive to expense ratios because how much money it can cost investors that I don't believe any actively managed fund can outperform over a 35-year period a simple index fund like the S&P 500 or a NASDAQ composite. Even NASDAQ composite I'm not that bullish on, but S&P or total market index fund, it's so difficult to outperform it. You really got to pick a needle in a haystack, and you just got to get lucky. And I don't like to get lucky. I like to find sound investments that have high probabilities of success. As simple as they may be, they're the ones that have the highest probability of success. And it's been proven since 1975 that indexing works, and it hopefully will continue to grab market share and continue to work in the future. Yeah,
it's great advice. Let's go the complete opposite end of the spectrum and talk about Nikola Motors. So you knew I had to bring it up.
Let's bring it on me, man. Lay it on me.
So last time we talked, it's funny because I was kind of recapping our episode as I was just preparing for this one, and you talked about, you're like, VTIQ, and I'm like, what is VTIQ? I was like, I remember that acronym, but I don't remember. So that was before the I guess it was the SPAC, right? Pre-merger, before it was Nikola, NKLA. And I do want to give you credit because at the time that we talked, and I listened to the whole conversation
hopefully I said Trevor Milton's unproven. I hope I said that. I don't remember.
You did say that.
Good.
You also, nothing you said could I go back and be like, that's ridiculous. How did he not? You know what I mean? Everything you said was legit. You said that there's an issue with, at least at the time, semis with batteries and range. You said that how hydrogen could potentially cause people or have the ability for them to go further. You talked about how they have a lot of challenges. That's what you said. You said they have a lot of challenges. If they're able to overcome them, I think that, they could do X, Y, and Z. You talked about how Trevor Milton had multiple failed businesses. And you were like, but, it could be the success story. We'll see. You never said he was, the next Elon Musk. So it's funny because I have a very small channel, but I remember when I put that one up, just because it was such a hot topic, there were a lot of people just kind of jumping on there and people saying, how could you believe in Nikola? And this is like 6 months later when, of course,
fraud or whatever.
Yeah, it's easy to look back 6 months later. So I just want you to reflect on it and then maybe talk to us about how you feel about them now.
Yeah, I mean, let me just get out front of it. I don't own any Nikola, and I haven't since probably the last time I sold it was like $48 a share.
Yeah, you sold a lot like after that huge run up, right?
So I got out after the run up because I knew, again, it goes back to they were not gonna be there for another like 5-10 years, because I knew they were like a pre-revenue company. And if I see somebody willing to pay me $50-$60 a share for something that I paid 13 or 15 bucks, I'm going to give it to you, man, because that company's not, I believe in it, but it's not that good. Then eventually, when the stuff broke about Trevor Milton, I can't say I was surprised because I did a lot of digging into him before I even started buying shares into the company. And he seemed shady, but he also seemed like a guy who's willing to go for it. And I'm like, you know what, this guy, he has the right attitude of somebody that I want as like a promoter CEO who's just gonna, be out there and, pumping the stock, not pumping the stock, but just promoting the company, kind of like an Elon Musk, not as smart as Elon Musk, of course, but just kind of, being on Twitter and being active and all that. And of course, all that backfired. And I haven't followed him since. I know he was under investigation. I have no idea how that panned out. As far as the stock, I know the GM guy took over. That was the last time I heard of it. Haven't been following it. I would not recommend anybody to do it. And as far as lessons learned, I think this is a good topic about why it's so hard to pick. Who would have predicted that something this hyped up would come crashing down like this? I certainly wouldn't have. I mean, I thought it was going to come back to earth after it was at like $100, but I didn't think, it would be back to like 15 or wherever it's at now. So this is a good lesson of why it's so difficult to pick stocks, even when you know what you're talking about, even when you do your due diligence. It's just, there's this great uncertainty about it. And that's why we shouldn't idolize people who pretend. I wouldn't even say pretend. People who put in the research and know that this is what's going to happen. That's still not something we should idolize, because nobody knows the future. Not me, not you, not Kathy Wood, and not even Warren Buffett or Charlie Munger or any of the greats. I think there's a lot of luck involved in that. So, I could have just as easily said the same thing about Tesla, 10 years ago and gotten lucky and rode the wave up. And I think I still made out pretty good with Nikola. I was happy with how much I made, but I don't do that stuff anymore, at least not on the channel. I do recently. Fisker is one that I've kind of, I've had a love-hate relationship with. It's one that I really think can be a serious contender. But at the same time, it's another one that has a CEO who's unproven, who's had a failed venture. So it's high risk, man. But I've just been doing some, I shouldn't even say this, but I've been doing some options on Fisker. Had like a call option, a $15 call option. The thing rode up to like 22. So made good money there. But that stuff is just, it's because the casinos here in Illinois are closed. So I'm just, winging it there. But as far as like any sound investing, I don't endorse any of that stuff, and I don't want anybody copying me on that. I think I'm ready to lose it all at that point when I put in $500 on an options call for Fisker to which was trading at the time at like 13 or something, and I bought an options that was like 2 months out and made some crazy money. But high speculation is either high reward or high risk at the end of the day. And you can have a Nikola or you can have a Tesla, but usually they all turn out into Nikolas and only a few turn into Teslas. So, but good on you if you have the Tesla at the beginning, which I didn't. And I still can't believe, just to harp on Tesla, I was buying Teslas like 300 pre-split, $300 a share, and I sold it at 700 pre-split, thinking, man, this cannot be any better than this. And how wrong I am, and how this is why I don't do individual stocks. I'm just terrible at it. I don't have a knack for it, and don't listen to me when it comes to individual stocks ever again.
Well, at least you've found your niche, right? And I think one thing that's taken the burden off of me when it comes to or Tesla, for example, having up multiple hundreds of % on it, like it's the understanding that I don't have to sell this thing ever.
No.
And as long as
you'll always be in the green. If you hold the rest of your life, you're never going to be back to what you paid for. At least, I don't want to say never, that's a strong word, but you're always going to be good. Yeah.
It's just, it's like, I think you can really stress yourself out if you think about, I'm up 150, I'm up 200, 300%, it doesn't matter how much you have invested in it. If you just tell yourself, I don't have to sell this. If I believe in this company, let's just take a look 10 years from now. And if things are looking like they're going south and things just continue to compile over and over again, then yeah, maybe you make that decision. But if you just tell yourself, is it down 10% today? Yep, it is. Okay, cool. I don't have to sell this. There's nothing telling me I have to sell this. It kind of takes the burden off of you with these individual stocks, in my opinion. But the whole EV space, man, we've talked about a little bit already. It's crazy. And Fisker, there's a few other ones. I feel like I see new ones popping up every day, and it just kind of tells me
CCIV is the hot talk, right? I'm staying away from that one, but
I have not even dipped my toe in that. It actually took like 4 weeks of me seeing CCIV all over the place to look up what it was, because I was just like, all these weird ticker symbols are probably these like SPACs or brand new IPOs, whatever. And I'm just like, I don't want to deal with that right now. But I think there's a lot of hurdles. I think I use the term easy relatively, but I think it's easy to create a prototype or like a serial code 001 of an electric vehicle. But I think what people don't understand is to manufacture these on a basis where they're going to be selling enough to bring in serious profit. I think that's a hurdle that a lot of people are overlooking. And look at Tesla. Look how long it took them to get profitable. It took them 10 plus years. and they're still barely profitable. They still made more money this year off Bitcoin than they made on selling cars last year. Like, they're barely profitable. What makes you think Fisker is going to jump in and be able to sell cars right off the bat? I don't get it.
Yeah, they're not. I mean, there's no thesis that I can put together that says in 5 years they're going to compete with Tesla. The biggest reason I like Fisker out of all the other manufacturers is they're outsourcing all of the manufacturing, and they're partnered with some really good companies. And again, I'm not holding it. I don't hold the stock. I'm not going to pitch the stock to anybody. Don't buy it. But I just think it's a better business model than trying to do it on your own where you manufacture everything in-house because of the cost.
Yeah.
I think Tesla and Elon found that out pretty quickly. Trying to make a car that's scalable, like the Model 3, is very expensive to do. And what happens is the bigger the economies of scale, usually profit margins get thinner and thinner as you're producing more. Yeah, the stuff is getting cheaper to manufacture, but still, you got to be competitive in the market with your price. But yeah, I think EV will probably be coming from some of these actual car manufacturers like Ford, GM, and companies that already make cars. That's their core business. They're probably going to end up taking the market share from Tesla. Not all of it, of course. Tesla has the first mover advantage, and they have a big moat in the sense that I think people that drive, let's ignore the stock for a second. People that drive Teslas are like iPhone users, man. They won't give it up. Like those people will be buying Teslas as long as Tesla's making Teslas. So that can't be understated, I think. But then when we look at the stock price and bring that back to the equation, I think it's run up way too much and it has to cool off and come back to earth, at least until Tesla starts to introduce the self-driving, introduce the semi, introduce the Cybertruck, get all this stuff that they've talked about out on the road so we can see them. I'm still looking for the first Cybertruck. I think that's coming next year. I don't even remember the date, but I just want to see this stuff before I even go out and buy my own. But they do have a moat. They do have a first mover advantage. And I can definitely understand why somebody would want to invest in the stock or even in buying the car itself. It's pretty cool, and it's definitely going to be the future. But they can't forever hit these price targets. I think I saw Kathy say it was 4,000 now or something by 2025. I mean, that I'm willing to, I don't want to say I'm willing to bet some money. That's terrible, but I might eat my words, but there's no way in hell.
Come on, Moki, short ARK. Put your money where your mouth is.
There's no way in hell. I'm not going to be a
Tesla.
No. I don't play that game. But there's no way in hell they're going to hit 4,000 by 2025. I see Tesla cooling off more. I think this has been the peak. And historically, stocks have a life cycle. I mean, not stocks, companies have a life cycle, but the stock price tends to follow that life cycle pretty closely. And they all peak and then eventually kind of find their, average, their moving average. And I think for Tesla, something like in the 400s is fair with the technology they have now. But again, we'll see what happens with that.
I think the interesting thing with Tesla is they are building such a core foundation right now. And a lot of the products that they could potentially put online are not going to be these huge pivots that they need to do. Right. So if they build out the core foundation, which is to build factories that not only produce the cars, but produce the batteries, not only can they potentially outsource the batteries to other companies, which Elon has said he's more than happy to do. He's basically, his whole goal is to get everything EV. So if that's going to happen quicker by having Tesla sell their batteries to other manufacturers, I think he'll do that. You think about other things that would be very easy to put online, Tesla insurance, right? People talk about that a lot. That's just basically paperwork. And then once full self-driving is online, people talk about the automated taxi service. All of these things aren't going to be these huge pivots for them, right? The big thing that was the issue was building out the factories, being able to produce the amount of cars that are in demand. Once that issue is solved, I think everything else could potentially fall into line. And that's where these ridiculous $3,000, $4,000 per share potential stock prices come into play. I think if they follow along doing the same thing that they've been doing, I think 5 years from now, it'd probably be between here, like a $600 to $1,000 stock still. PE ratio would come down maybe from 1,000 to like 700. I don't know.
Good, right? That's still, I don't know.
Hey, at least in terms of ARK, they have a PE ratio, right? Most of the companies
on the charts somewhere in the 80s.
Yeah.
No, I agree with you, man. I think they built out that core business. They're not going to be pivoting, but at the same time, it's very important to know that we don't know where their biggest revenue source is going to come from. Like, look at Amazon. Amazon started selling books, and then they transitioned to online sales. But their biggest source of revenue is Amazon Web Services.
Yeah,
it didn't exist. Like Amazon didn't. So there's all these projects that companies invest in, and some are hit and some are missed. But we don't know, where it's. I think for Tesla, self-driving is one of those key things that they need to get into place so that the taxi service can happen, so that people actually can trust a car to drive itself, so that infrastructure can start being built around self-driving cars. Because there's no way with the potholes in Chicago, you're telling me that, I don't care how advanced the technology is, you put a Tesla on these roads, that thing is going to go crazy. So there's a lot of moving pieces that have to happen for that core thing to happen. And I think for Tesla, their biggest advantage is going to be the self-driving. And I think a lot of manufacturers are just trying to catch up with the batteries right now. And Tesla's got the batteries figured out, and they're already moving on to the other. So their first mover advantage is working, but they just got to start executing, man. I mean, we can't keep waiting for self-driving forever, because eventually there's going to be a company that figures it out, and they might be able to do it better. And if they do, then that 1,000 or 4,000 share price is going to be in trouble, because people are going to be like, well, this is overvalued for a company that makes cars. They're not. But if they have self-driving, and if they have the insurance, if they have the financing, if they have all these other branches of their business, absolutely, man, the stock can go up infinitely. In my opinion, it should be worth a lot more. But where it's at right now, we have to evaluate it where it's at right now. And I see it at 400. Just some quick math and some of the stuff that I've done, but my opinion and Kathy Wood's opinion and your opinion are just that, they're opinions. I mean,
the market will decide.
Yeah, the market will decide how much Tesla stock is
That's
worth.
the beautiful thing about investing. We can talk all we want. The heads on CNBC can talk all they, or MSNBC, whatever, they can talk all they want. But the market will decide, and it should be fun to watch. I think the last earnings call, they said that they think, and again, they think, so they know more than I do, but who knows what'll happen. Tesla thinks that their solar panel service will actually be bigger than the car service, which again is crazy, right?
It's interesting. Yeah. I didn't know that, but that's what I'm talking about. So Amazon Web Services branched off of Amazon to become their biggest. So it might be something, that maybe is not even car. They don't know, but if they think that, I'm sure they have good information and intel that there are, I'm assuming, getting good revenue from whatever the solar panel business is. So I mean, maybe Tesla in 10, 15 years is primarily a solar panel company. I don't know, but it might be something completely different than what we see their core business as today. Yeah.
And the other thing that I think is overlooked is if you're a brand new, engineering student out of Stanford, you can go work for Ford, you can go work for Tesla. The smartest ones are going to Tesla. Potentially there could be another company that comes out and says, we have full self-driving figured out, cars on the road. But man, it would be super surprising. And I would really want to know who's in their back room, like who's been staying quiet for the past 10 years that just figured this thing out. It could happen, but it just seems unlikely to me.
Yeah, I agree. I mean, it goes back to like working for these big tech companies like Apple. You're not going to leave Apple to work for some kind of startup company or IBM, right? So, I mean, I agree with you 100%. Everything points to Tesla really having a long and successful future. I don't disagree with that. And I'm technically a share owner. 90% of my portfolio, or 80, now it's down to 80%, is in the total stock market. And Tesla is its sixth biggest holding. So I shouldn't be talking smack about a stock that I'm got like 3.5 or 4% in right now, technically through the index fund. So I just think I like the fact that my index fund will figure out which one is going to succeed, which one's not. And I don't have to worry about it. Cause if you're an investor worrying about this stuff, it'll drive you crazy, man. You'll probably have a lot of sleepless nights and make a lot of bad decisions and all that. But unless you're someone like Rich who can buy and hold it and see all those gains and say, I'm not selling, I'm not freaking selling. That's awesome, man.
Not leaving.
I'm not leaving. That's the stuff that makes good investors long-term. That's the stuff that makes investors money long-term, whether you're buying holding a stock that you have a big belief in, or you're buying holding an index fund or an active fund, whatever the case may be. The key point is buy and hold it, don't trade it, and you're going to make some money eventually if you hold it long enough.
Yeah, I know a lot of the super Tesla fanboys on YouTube. I'm sure you've seen some of them where it's like a Tesla can do no wrong, right? There's zero Tesla can do that goes wrong. They were loving the fact that Tesla was added to the S&P because they're like, now everybody who for it. Yeah, they're like, now everybody who's bashing it has it, whether they like it or not. So that was like a big win. And we got it
at like $800 a share. I don't know what. I haven't looked at the monthly breakdown of the prospectus for FXAIX, but I'm sure they paid $750, $800 a share. So yeah, I mean, that's the beautiful thing. It really, we don't know, and people that got in early on, great for them, and people that didn't and still want to invest in it, great for them. But again, I just got to harp back to the point. I let my index funds do all that important picking for me because I admit unfortunately, I'm not smart enough to do it myself. Nor do I just really want to spend the time stressing myself out and picking a Nikola, which I was, if I would have gone down that road with Nikola and like you did down Tesla, you made out on the positive end. But let's say I kept buying up and averaging up in Nikola, I would be in a very bad spot. And I would probably hate my life right now, and I wouldn't be a very happy investor. So I'm glad I don't do that. Not to discourage anybody. I mean, you can do whatever you want. We're not financial advisors here. We just kind of talk about this and have fun with it. But it just makes it so easy, man, when somebody else does the work for you and you just see your money grow. At the end of the day, we're all here for the same goal. We all want to see our money grow. And whether that's through, 800% increase in Tesla or 100% increase in ARK or 20% increase in the S&P 500, our money's growing. And that's the beautiful part of it.
I love it, man. That's a great way to wrap it up. It's fun to have these intellectual conversations about individual stocks and stuff, but as long as you have that core basis of investing down, that's what's really important. So I'm really stoked we got to do this again. We'll have to do this more often and maybe not talk about Nikola again. Maybe we'll just put that one behind us for now, but go ahead and shout out kind of where everybody can find you again. And I got one more question for you after that.
Yeah. So you guys can look me up under Moki Finance. That's MOKI Finance on YouTube. I do a weekly podcast series under the Moki Finance Show. If you guys have any questions, mokifinance@gmail.com is the email. I respond to every comment, every email. If you have questions about index investing, I stay away from advising people on stocks anymore. So you can shoot me those questions. I probably won't have an answer for you. And thank you, Rich. I know you got one more question, but thank you for having me, man. This has been an honor and a pleasure to be back on your show. I think you're doing great things here, giving people different perspectives, and stay the course with the YouTube stuff, man. It's going to take off. I know it's going to take off for you. You do some good work here, and eventually, hopefully, you can be in the position where you can say, you can do this full time, and if this is your passion, follow that as well.
Yeah, I appreciate the words. Last question for the night. I've been trying to ask this to most people, but if you could have 24/7 access to one mentor, dead or alive, who would it be?
Right
Bogle?
Here. Right here, man. My biggest, I mean, the crazy part, let me wrap this up. I hate wrapping stuff up on a somber note, but he passed away 7 days before my grandpa passed away. And my grandpa was almost like a father to me. But if I ever make it big on YouTube, my biggest regret will probably be not getting a sit-down interview with Jack Bogle, because he's somebody that I have listened to every single appearance, podcast, anywhere I can get him. I've read all 10 of his books. He's really one of those people that selflessly made a product for everyday investors. He could have been a billionaire, but he chose not to go that route. He made a product that would benefit people like you and me. And that kind of selfless act really needs to be kept alive, in his words and all the wisdom he's been giving to people since 1975 needs to be out there. So my biggest goal, he's the one that I would have loved to meet and sit down and talk to, but my biggest goal is to make sure that his advice lives on, and that everybody stays the course and buys low cost index funds as their core holdings.
I love it. Yeah, it's a good way to help his legacy live on, right? And you can do that through your channel. So everybody, please go check out Moki Finance. And again, had a great time, man. Have a good night.
Yeah, you too, brother. Take care, man.